Yo, what's up, future real estate moguls? Welcome to the ultimate guide on how to invest in real estate as a beginner, where we break it down step by step so even your dog could understand. But please, don't let your dog buy a house. We're about to dive deep into the world of buying, selling, and renting property, and trust me, it's way more exciting than watching paint dry. Unless you're flipping houses, then maybe it's a little bit like that. Now before you go out and drop your life savings on the first fixer-upper that looks like a haunted house, research, and research some more. Because the real estate game is basically Monopoly, except losing means actual bankruptcy, not flipping the board and storming off. Look at what successful investors have done, and more importantly, how they failed. Because the best way to learn is by watching someone else mess up first. It's like learning to ride a bike by watching someone else fall off and get a face full of asphalt. Except instead of a scraped knee, you're risking your credit score. Alright, let's talk strategy. The first thing you need to figure out is what kind of real estate investor you want to be. Are you the house hacking type, living rent-free by renting out your spare rooms to friends, or strangers who will quickly become your friends, or your worst nightmare? Or maybe you're more of a flipper, buying rundown properties, slapping on some fresh paint and reselling them for a sweet profit? House hacking? This is how I started, and it's perfect for beginners. You basically buy a multifamily property, think duplex, triplex, or even a quadplex if you're feeling ambitious. Live in one unit and rent out the others. The rent from your tenants helps cover your mortgage, and you get to live for cheap, or even free, while building equity. Flipping. This one's for the HGTV addicts. You buy a property that needs some TLC, renovate it, and then sell it for a higher price. Sounds easy, right? Well, it can be, but it also comes with its own set of challenges like unexpected repairs, dealing with contractors, and the pressure to sell quickly before your holding costs eat into your profits. Rental properties. This is the long game. You buy a property and rent it out to tenants for steady passive income. The key here is to find a property in a good location with strong rental demand. Buy and hold. This is the simplest strategy. You buy a property and, well, you hold on to it. REIs. Don't want to deal with the hassle of owning physical property? REITs, or real estate investment trusts, are like mutual funds for real estate. Remember, there's no one-size-fits-all approach to real estate investing. Okay, so you've got your strategy figured out. Now, let's talk about the not-so-fun part. Money. Unless you've got a Scrooge McDuck vault full of gold coins, you'll need to secure financing to buy your first investment property. Here are a few options. Cash. The most straightforward and often the most difficult way to buy real estate is with cold, hard cash. Mortgage. The most common way to finance a property is through a mortgage. This involves borrowing money from a lender and paying it back over time with interest. Hard money lenders? These lenders are more concerned with the value of the property than your credit score, but they also charge higher interest rates. Private money lenders. These are individuals or companies that lend money based on their own criteria. Partnerships. Don't have enough cash for a down payment? Team up with a partner. Seller financing. In some cases, the seller of the property might be willing to finance the purchase themselves. Remember, securing financing is a crucial step in the real estate investing process. Take your time, explore your options, and don't be afraid to ask questions. After all, you're about to make one of the biggest financial decisions of your life. Be prepared and informed. Let's move on to finding that dream property. Now for the fun part, property hunting. This is where you get to play detective, scouring the market for hidden gems and undervalued properties. But before you start browsing listings with hearts in your eyes, let's talk about what to look for in an investment property. Location. The location of your property is crucial to its success. Look for areas with strong rental demand, low crime rates, good schools, and proximity to amenities like parks, restaurants, and public transportation. Property type. Are you targeting single-family homes, condos, townhouses, or multifamily units? Each property type comes with its own pros and cons. Condition of the property. Are you a seasoned DIYer ready to tackle a fixer-upper, or do you prefer a move-in ready property? Rental demand. Before you buy a property, make sure there's actually a demand for rentals in the area. Future potential. Look for properties with the potential for appreciation or value-add opportunities. Numbers. Don't let emotions cloud your judgment. Analyze the numbers carefully, including the purchase price, closing costs, potential rental income, operating expenses, and cash flow. Use technology to your advantage. There are tons of online resources that can help you find and analyze investment properties. Work with a real estate agent. A good real estate agent can be invaluable in your property search. Don't be afraid to walk away. It's better to walk away from a bad deal than to overpay for a property that doesn't meet your investment criteria. Alright, it's time to put on your financial analyst hat and dive into the numbers. This is where you separate the real estate dreamers from the real estate investors. Remember, a property might look beautiful on the outside, But if the numbers don't make sense, it's not a good investment. Cash flow. This is the lifeblood of real estate investing. It's the difference between the rental income you collect and the expenses associated with owning and operating the property. Positive cash flow means you're making money each month, while negative cash flow means you're losing money. Return on investment, or ROI. This metric helps you evaluate the profitability of your investment. It's calculated by dividing your annual net profit by your total investment. The higher the ROI, the better. Cap rate. Short for capitalization rate, this metric is used to compare the potential return of different investment properties. It's calculated by dividing the property's net operating income by its market value. A higher cap rate generally indicates a better investment. Cash on cash return. This metric measures the return on your cash investment only, excluding any financing. Debt service coverage ratio, or DSCR. Lenders use this metric to assess your ability to repay your mortgage. It's calculated by dividing your net operating income by your annual mortgage payments. Gross rent multiplier, or GRM. This metric provides a quick way to compare the value of different rental properties. It's calculated by dividing the property's market value by its gross annual rental income, analyzing the numbers. Once you've calculated these key metrics, it's time to analyze the numbers and see if the property meets your investment criteria. Don't be afraid to walk away if the numbers don't add up. Congratulations, you found a property, crunched the numbers, and you're ready to make an offer. Now comes the final stretch, closing the deal and officially becoming a real estate investor. Making an offer. Your real estate agent will help you draft a compelling offer that takes into account the property's condition, recent sales in the area, and your own investment goals. Be prepared to negotiate with the seller, and don't be afraid to walk away if you can't reach an agreement that works for both parties. Inspections and due diligence. Once your offer is accepted, it's time to conduct inspections to identify any potential problems with the property. This includes a general home inspection, a pest inspection, and potentially specialized inspections for things like radon, mold, or lead paint. You'll also want to review the seller's disclosures and order a title search to ensure there are no liens or other encumbrances on the property. Securing financing. If you're not paying cash, you'll need to finalize your financing with your lender. This involves providing documentation of your income, assets, and debts, as well as getting the property appraised to ensure it's worth the loan amount. Closing day. This is the day you've been waiting for. You'll sign a mountain of paperwork, transfer funds, and officially become the proud owner of your first investment property. Managing your property. Now that you're a landlord, you'll need to decide whether to manage the property yourself or hire a property manager. Finding tenants. If you're renting out your property, you'll need to find reliable tenants. Advertise your property online, screen applicants thoroughly, and check references to ensure you're choosing responsible renters. Collecting rent and handling maintenance. Establish a clear process for collecting rent and handling maintenance requests. Dealing with vacancies. Vacancies are an inevitable part of being a landlord. Minimize vacancies by keeping your property in good condition, setting competitive rental rates, and marketing your property effectively. So, you've made it to the end of our real estate investing crash course. You've learned about different investment strategies, how to secure financing, how to find a property, how to crunch the numbers, and how to manage your investment. Now it's time to put that knowledge into action. The cost of your first property will depend on your location, but let's say you're going the budget route. Expect anywhere from $50,000 to $300,000 unless you're in California, where that gets you a shed. The potential revenue, a few hundred to a few thousand per month in rent if all goes well. Losses? Oh, plenty. Repairs, vacancies, market crashes, and that one tenant who mysteriously vanished without paying. Pros, passive income, appreciation, tax benefits, cons, risk, high upfront costs. Tenants who think rent is optional. This is not financial advice, just an explainer video. So invest wisely, do your own research, and most importantly, don't let Instagram gurus convince you that you'll be a millionaire by next Tuesday. Now smash that like button before your dream property gets bought by an all-cash investor from overseas. Subscribe. See you in the next video.